if anybody kind of misses it or they want to get a recap or you want to see something that we talked about in the past. We talk about a range of topics in this meetup group. So thanks guys. Carmelo, so it's recording. The floor is yours if you want to take it away, man.
Thanks, Alex. Thank you everyone for joining us tonight. Today we're going to be talking about the Bank Canada interest rate decision announcement. To begin the introduction, myself, I'm Carmelo Boutis. I'm a mortgage agent at yourmortgageyourway.ca. Find my Instagram and email address.
Yeah. I'm Alex Winiewski, Toronto Realtor with Remax Condos Plus, top 1% condo sales since 2022. There's a QR code there as well. If you want to scan that will take you to my link tree. There's all my stuff is there.
You're a lot more fancier than I am, Alex, with these QR codes.
It's not hard to make a QR code.
So again, Bank Canada had a meeting today. What happened? Well, there was no rate change. The overnight lending rate remains at 2.75%. The one thing I found interesting was I listened to half of the webinar that they presented. Bank Canada, they see two scenarios happening. Now, instead of kind of like going, I'll be going into the scenarios, but the Bank Canada, they have a little video they put on their YouTube channel. I'm going to share it right now and for us to listen. It's really short, so.
Go ahead. Okay.
So I found that interesting, like how they did a short little video saying how the economy began at the beginning of the year, and then how there's a lot of uncertainty with these trade barriers and these tariffs happening. Oops, I don't want to do it again. But there we go. So there are two scenarios they talked about, right? And this is from the meeting. The first scenario was the Bank Canada, they're assuming most of the new tariffs will get negotiated away. But the process is unpredictable and business and households remain cautious. GDP growth in this scenario stalls in the second quarter, then expands only moderately. Inflation will drop below 2%, the target for the rest of 2025 and in 2026, both because of the end of the consumer carbon tax and weak economy.
So this is like a very optimistic, this is their optimistic outlook, right? The scenario one?
Yeah, scenario one is their optimistic outlook with regards to like these new tariffs. They're going to be short-lived. Inflation will still dip below their 2% target for the rest of the year. But the reason for it, because of the end of the carbon tax and the weak economy. So that's what's going to make inflation, they're saying they're going to keep inflation under 2%. And
so weak economy and the carbon tax going away. So it's not too optimistic, but it just.
Yes.
Okay.
But it's the second scenario is we assume a long-lasting global trade war. The economic consequences are severe. Canada's GDP contracts in the second quarter, and the economy is in a recession for a year. Growth gradually returns in 2026, but remains soft throughout 2027 as the U.S. tariffs permanently reduce Canada's potential output and lowers our standard of living. Inflation rises above 3% in the middle of 2026 as tariffs, countermeasures, and shifts in supply chains raise costs, pushing up many prices. Inflation then eases as weakened demand limits ongoing inflationary pressures. To be clear, these are only two of many possible scenarios.
Right.
Even those not span the possible outcomes. Like, so what Alex, they're saying two different things.
Yeah, they're saying two different things, but they're also saying that nobody really knows what's going to happen. I mean, this is just two possible scenarios. One is that we negotiate all these tariffs away, or most of them, and then our economy is still weak, and then inflation's down. And the other one is that Canada is literally basically screwed as a trading partner, and our standard of living, goes down as prices across the board for goods go up by about 3%. But one thing to keep in mind, though, I think, is that after winter, there's always a spring. And I think that scenarios like this, regardless of what happens, is going to make our country, have to find new solutions, find new trading partners, new trading routes, and eventually we will come out of this on top. It might be a painful couple of years, but I think that for the most part, both of these scenarios, while not overly optimistic, they're not like catastrophic here. We're not going to become like a developing nation.
Yeah, I agree. But the one thing I see in common with both of them is a weak economy.
Yes.
Right. And again, the Bank of Canada, their main mandate is to focus on inflation, not so much the economy. So it's like, if inflation's going to still be under 2% and we're going to have a weak economy, scenario one, why wouldn't they lower the rates? If they're focusing on inflation and the target rate is 2% and they forecast 2%, why can't they lower the rates to support the economy, to help the economy? Right. And but then scenario two comes in where inflation rises above 3%. And if it goes over, we don't want to see what happened in the past.
Yeah. But I think also the government has some stimulus plans as well, depending on how things go for certain industries. And I think that both these scenarios, or any scenario, I think it's going to be mostly felt in cities outside of the GTA, like outside of Toronto.
It's going to be it's cross country, right? Like, it depends on Ontario, Southwestern Ontario is heavily impacted by the auto and the auto industry and the steel and aluminum tariffs. But it impacts really all Canada.
Right.
So, ironically, like usually the last 7 meetings we had a Bank Canada rate cut and my phone will go crazy. This time I'm on my laptop. Is like, where is everyone? Nobody's asking if their fixed rates are coming down or anything like that. And
right.
So I want to take a look back with regards to what's kind of happened in the last 12 months. And the blue line is the Bank Canada meeting, and the Bank of Canada, they only impact anyone in a variable rate loan, mortgage, line of credit. That's when that happens, when the Bank of Canada makes an increase or decrease, it only impacts that variable rate mortgage, home equity line of credit, unsecured line of credit, unsecured loan. Fixed rates are tied to the 5-year bond yield. And you can see over the past year, like the blue line, the variable rates, those were a lot higher. And those come down quite a bit. They've come down over 2.25% over the last 7 meetings. Well, the 5-year bond rate only come down by maybe 1%. So a lot of people who are waiting for these Bank Canada to make a decision on and getting a fixed rate loan, they're not connected. We're going to get back to the period where variable rates, I anticipate to go lower to fixed rates.
I anticipate that as well. But there's been a lot of, the bond yields have been moving substantially over the last 3 months, like up and down, like crazy swings. It seems like every day the president down south tweets something and I don't know if it's called tweeting anymore or Xing or whatever it's called, posts something, says something, sneezes on something, and then the stock market goes crazy. The bond yields are going all over the place.
Well, am I able to ask a question?
Go ahead, Milan.
I've probably heard it 100 times what Carmelo just explained, how it's like tied to the 5-year fixed rate and then the variable. Can we tie in for like us newbies a little bit more? Like obviously these announcements affect the variable people the most, you're saying, but could we like I've heard it, but I just still can't grasp it, even though I've heard it a million times, just a little bit better how to understand this charts of variable and fixed rate stuff, like how this stuff impacts us. Like, just I don't know why. I just have a hard time with it.
To get your question, Milan, just like so that I make sure that we get it so that we can answer it. So you want to know, how does the overnight rate impact your
Like, what are you
mortgage
guys
rate.
showing us? What are you guys showing us on that chart, and what are you guys
Okay.
predicting on
Yeah.
this chart? Like, I'm having a really hard time, like, actually, like, being on the same page. Like, you guys are a bit ahead of, let's say, me and maybe some other people, but like, I've heard this so many times, I just still can't comprehend it.
Okay.
Let's
So
try it.
I'll try to break it down a little bit, maybe say the same thing a little different. First and
Mm-hmm.
foremost, this is not for anything for forecasting. This is just what happens in the past. So in the past, if you're looking at, the best way that I like to look at it as you're the bank. You're lending, the bank is, you're going to be the bank and you're going to be lending somebody money. Now, when you lend money and I want to give someone a loan for 5 years, the banks ironically do not use their own money. They borrow that money to give to you. So when the bank borrows money, the benchmark and the only information we have is for the public is a Canadian savings bond that's issued for 5 years. Because that there's, I don't want to get too into it, but like the stock market, that trades at, there's people that invest in, buy and sell the Canadian savings bond on a daily basis. So, when the bank borrows money to lend, if you're the bank and you want to lend somebody money, you have to borrow it, and you're going to be looking at the 5-year Canadian bond yield. How much does it cost for you to borrow it? For them to charge your consumer, a premium, because you need to earn money. Like you're a bank, you do it for profit. The same thing when it comes to somebody who wants to borrow a loan with a rate that could change. Well, the bank,
Variable rate.
yeah, variable rate. So the bank borrows the money from the Bank of Canada. And if the Bank of Canada is offering an interest rate of 5%, that's their cost. Then how does it work to the consumer? If you have an unsecured line of credit, it's prime plus 3, 4, 5, 6%.
I wasn't following on the chart. Sorry, I wasn't following. Which line is the variable and which line's the fixed?
So
on that chart?
the blue line is the variable, because it doesn't move that often.
Okay.
This is with all the meetings. And the gray line is the 5-year Canadian bond yield, which would be the fixed rate.
Okay.
And the bank makes money on the difference between what they're borrowing money at and what they're lending money to you at. So if it's like a variable rate mortgage, it's prime. Okay, basically what that is overnight rate. So what the blue line means, plus 2.2%, and that's the prime rate. The 2.2% is the split, and this is what they're, what's kind of between what they're borrowing money at and what they're lending to you as a consumer. Does that make sense? Sorry, you're muted, so I don't know if it makes sense or not.
Yeah, I would say so. So just so I'm clear there, then the variable line at the top, the bank charges 2.2% and calls that
On top
prime.
of that, and that's prime.
And then with the variable one,
the fixed one, which is the bond yield.
Which is the gray one.
Oh, the fixed one is the
Yeah.
bottom one.
Yeah.
And they charge maybe how much more over or that?
Depends
rate?
on the product. It could be anywhere between 1 to 2%.
And banks also have
Okay.
promos sometimes to
This-
attract you as a consumer. They
Mhm.
might give you like prime minus 0.5%,
Mhm.
something like this, right?
Yeah, it's not a promo, Alex, because again, it's like when you get let's use it as a mortgage, for example. This line, like the Bank of Canada, their overnight rate today, they left it at 2.75. But as all of us, if we went to go to a bank to get a mortgage, all the banks have a prime rate of 4.95. That difference is 2.2. That's a spread. They're making that money. Now, on a mortgage, you get obviously a discount from prime. The bank may give you prime minus half, prime minus 0.6, prime minus whatever it may be, prime minus 3, prime minus 1. But the bank will always get that profit because they're borrowing at 2.75 and then lending it at 4.95. And whether there's a plus because you have a home equity line of credit or a minus because it's the mortgage, that's how they make money.
Does that kind of make sense?
Yeah, they're always making a spread off whatever rate they're going to borrow.
Yeah,
that's
for sure.
That makes sense.
That's how they make most of their money. Most of the bank's job is to lend money.
Yes.
Understood. And I guess, is there any problems going on these days with people doing things a little backwards? Like, for example, in Cali, I think it was, this Silicon Valley Bank did a lot of. I don't know if maybe that's outside of your guys' interests that far, but
So what happened in 2008 and 2009 when the housing market crashed in the U.S. because they were giving
it was
subprime
something recent where
2023.
Silicon
Yeah.
Valley Bank. They
Maybe
did
Carmelo
something.
knows. I'm not.
So
What?
I'm limited to my knowledge about that.
Okay, got
but
it.
it's the U.S. banking is the regulations and the rules there are very different. So it was just a bank that took on too many investments. They bought a bond, and as a bond, it's as the yield goes down, the price goes up, and it's just I think we can have a whole different conversation and presentation about that, right? So I rather kind of if it's okay, Milan, just focus on Canada and our Canadian banking system is a lot more regulated than the U.S. and it's a lot safe. I don't want to say safer, right? But we only have let's call it 6 big banks. The U.S. have regional banks, banks for every counties, and also the banks that are across all United States. So their banking system is much different than ours, and I like to think it's a lot more sophisticated because the things that they do are different. They do 30-year mortgages versus where we do 5.
I do like to follow a little bit of what Warren Buffett invests in, and I've noticed that a lot of the Canadian banks, in terms of the ratio that he looks for, which is return on assets from a bank, it's half of what the banks that he would choose to invest in are. So I wonder if the banks that are big banks, if they're half as strong as an American bank like Capital One. That's what I kind of wonder. Do we ever foresee any bank issues down the road based off of
that? I don't know much with regards to the financing investment side with regards to comparing Canadian banks to U.S. banks.
I think our banking system is a lot more conservative, and they take on a lot less risks, or not necessarily risk, but they're less creative in the ways that they do things compared to the U.S. And that's why you hear about some challenges with U.S. banks, like what you mentioned, the Silicon Valley Bank, where yeah. But I'm not totally well versed. Are you in the U.S. or where are you, Milan? Are you in Canada?
No, I'm in Canada, but I kind of follow a lot of from the investment point of view, and then I thought about going into mortgages a bit, but it's very new. I wasn't really in that field. I was kind of more I have a background in various areas, and I was just trying to understand things as best as possible so that I could integrate it into other things that I'm looking to learn
Sure,
about.
man. Yeah, so, good stuff, man.
Hopefully, again tonight you can learn some stuff with regards to today's Bank of Canada meeting and stuff.
For sure, I am. Yeah.
So, this chart just what we want to illustrate is just kind of the difference in how, when the Bank of Canada makes the changes. So anyone with a variable rate loan or a mortgage, you don't get that same impact. You can see there's not the same impact. The variables come down so much more than the fixed. They started at 5, now we're at 2.35 versus started under 4 and we're still under 3, right? The difference is they're not 1 for 1. The next thing is again what's happening with inflation in Canada.
May I ask? What were you trying to say is better? You said wasn't 1 for 1, but what were you trying to say is a better thing to do and take as a consumer? Which one would you be taking, knowing what this chart is showing you and why?
Milan, that's a very good question. So as a consumer, you should be looking at, the questions I asked, what are your future goals? What's your intent for the money you're borrowing, whether you're buying, refinancing, and so on and so forth. And that's going to help determine the length of time and the duration and type of mortgage you're going to get, right? If you're someone who doesn't sleep well at night and because your mortgage payment may change, then it's hard to recommend someone who's taking a variable rate. The variable rate, not that it's riskier, it's something you do need to stay on top of because over 5 years, if rates were to go up, you may need to look into locking into a fixed rate sooner. So getting a mortgage, variable, fixed, they're 2 different products. They do the same outcome where you're borrowing money, but each one has its own advantages and each one has its own disadvantages. It's finding what suits you, not so much what I would do, right? So I try to do information is a way to cater based on your needs and your requirements. Because some people I know they want to buy their first time home, and they tell me like, "Oh, I know in 3 years I'm going to be doing educational studies, getting certificates, and Salesforce or something like that, and their job and their income is going to go up significantly." And all of a sudden, they know they're going to move out in 3 years. Like, why would you take a 5-year fixed if you know you're going to break your mortgage, right? So there's no such thing as one's better than the other. Each one has its own advantages and disadvantages.
I think that popularity-wise, most people go with five-year fix. That's the most popular mortgage product. But yeah, like Carmelo said, it really depends on the purpose of your purchase, how long you see yourself holding that property. Are you going to have a hard time going to sleep if your interest rate went up by 0.5%? You know what I mean? So it's like, it's kind of also like based on your on your tolerance for these things. And also, I guess, like what you personally believe is going to happen. Now, we're not predicting anything in these webinars because nobody knows. Nobody can predict this. If we were telling you we can predict what's going to happen 2 years from now, it would be like just selling you BS, right? So it's we just report kind of like on data and then on our opinions, but it's also like our just like what we believe is happening and what we think. It might not, yeah. So yeah,
for sure.
Is it okay to move on?
Sorry, please go ahead.
Me.
Okay,
So
Milan
I
and
was
then
trying
Henry.
I was trying to understand. This presentation was about something that happened with an announcement, or is about to happen with an announcement?
It's an announcement that happened today. So the Bank
Oh,
of
it happened
Canada,
today?
you see the blue line, how it goes down? Every single time that it goes down is a Bank of Canada meeting. So they have a meeting every month and a half where they decide if they're going to make a change to the overnight rate or if they're going to keep it the same. Today, they didn't make any change. They kept it the same. The last 7 meetings, they made a change. Every time it went down, they made a change. So we're just basically talking about what happened today so that people can kind of like understand what that means. Because, we do come across many people that think that, for example, this Bank of Canada meeting and their overnight rate decision impacts their fixed rate mortgage, which it doesn't. It impacts your variable rate mortgage. So that's kind of what it is. We're just basically summarizing and having a discussion about what the Bank of Canada decided today as far as overnight rates. Henry?
Two related questions. First is just curious, in the Canadian mortgage landscape, what is the availability of fixed rate mortgage over 5 years? Say if I'm looking for 10-year, 20-year, or like US 30 years, how available are those mortgage from major provider? And two, to the extent that they are available, how competitive are they versus, say, the cost of funding for the bank?
Can you rephrase that question? There's two different questions, and I want to make sure I understand it correctly. Like Canada, are you in Canada or United States?
Canada.
So anything with regard, you mentioned United States mortgages. Like I can't really comment or talk to you about. I'm not that familiar with United States mortgages. So
my question is, first, in Canada, what is the availability of fixed rate mortgage over a 5-year term? Say if I'm looking for a 10 years fixed rate mortgage,
okay,
how available is that? Just in terms, if I go to the big 6 banks, do they all provide a 10-year fixed rate mortgage? So that's the first question. And two question, to the extent that they are available, if I can go to RBC and get a quote on, let's say, a 15 and 20 years fixed rate mortgage rate, how competitive are those rates?
So in Canada, you can get a fixed rate mortgage anywhere between 1, 2, 3, 4, 5, 7, and 10. Anything over 5, the banks charge a really large premium, or it's really not. Nobody's ever interested in them because the rates are just so much higher. I don't even follow those. Not that consumers ask me, but doing this for 20 years, I've always seen such large premiums, say on a 10-year mortgage. I did the math many, many years ago where if you took 2 5-year fixed rate mortgages and compared that to a 10-year mortgage at a higher rate, that on that second term, that second 5 years, you need the rate to be significantly higher, like 3 or 4% higher, to lose money. Now, that example may not apply today because rates are different than what they were like over 10 years ago. But 10-year terms are available if you're interested. If you're interested in kind of discussing that, I don't mind looking them up for you. But that's something we could do. Like if you want to book a meeting with myself, I could go over those 7 and 10-year products for you. But they're available with all the banks.
There's a link in the chat to book a call if you wanna talk about that.
Yeah.
Now the second question, I think. What was the second question?
Yeah, I think was answered already too. So let's say the 10 years fixed rate mortgage is available in the market.
Yes.
How competitive are they? And seemingly they are not competitive at all.
Not at all.
Not at all.
Okay.
Good question. Again, I never even look at 10-year mortgages anymore because the last time, again, they're like, I mean, they're significantly higher. It doesn't make sense. And the penalties to break a 10-year mortgage can be extremely high. I'm talking numbers that they're well beyond 5 digits. So it's not like the United States. The United States, they have these long terms, but how they do their mortgages are very different. And that's not what we're talking about tonight. So back to today's meeting, right? And back to what the Bank Canada is looking at. They talk a lot about inflation. And let's take a look at what's happened in inflation over the last 12 months. We've had inflation come down to reasonable levels. Literally almost a year ago, inflation was at 2.9%.
Mhm.
And it's come down in September as low as 1.6. And all of a sudden they're lowering the rates and inflation. Because inflation was the main reason why the rates went up in 2022, 2023.
Can you explain what inflation means? Just because we do have some newer people.
So inflation is really the cost of an item, the cost of an item today compared to last year.
Okay.
But the inflation, Canada's inflation is based on a basket of goods. Let's just say 100 different items from bread to groceries to petrol to housing to, purchasing a vehicle and furniture and a TV. So they got a basket of a lot of goods. They put them all together. And what was the cost of that basket last year versus this year?
Okay, so what this is saying is that this March, this basket of goods was 2.3% more expensive than last March.
Yes, and the note from last March was from 2020. That would be from 2023. So in March of last year, it was the basket of goods was 2.9% higher than the year before, 2023. Okay. So inflation is something where it's the cost of our goods, right? Like these tariffs coming out is going to raise the prices of a lot, certain items, and the fear is it's going to carry over to other items, right? So we saw inflation come down, and inflation is something we don't want in our economy. We don't want this, if prices are constantly going up, it kind of distorts with regards to how we're going to, spend our money. Mm-hmm. So we had inflation under control, but now it's starting to tick back up. And the Bank of Canada's mandate, their goal is to keep inflation between 1% to 3%.
Cool.
And with these tariffs coming, that's where kind of like we had some sort of control, and now they don't know what's going to happen.
Milan, what's your question?
I assume you guys pull those charts quite frequently, but I would like to know if I want to follow along on my screen where you guys found those charts. Like, do you guys know how this Stats Can?
Yeah, Statistics Canada inflation number. So just Google Canada inflation rate, Statistics Canada.
There's a lot of websites where you can find this data. Stats Canada, Bank of Canada, even just Googling Canada's inflation rate. You'll have a lot of different websites. They'll show you different charts.
And the mortgage rates that we had previous on the screen, what website was that?
So these are not mortgage rates. This is the Bank of Canada overnight lending rate. It's kind of, I don't know if you can see it on your screen at the bottom. The blue line says Canada interest rate. That means the Bank of Canada. And Canada 5-year means Canada 5-year bond yield. Mm-hmm. So these are not the mortgage rates or variable rates you're getting. These are the Bank of Canada's overnight lending rate and the prime rate. And as well the 5-year Canadian savings bond yield. Again, you just Google is very handy and helps me when it comes to getting some of these slides, right?
But I'm on Bank of Canada website, and I'm trying to figure out where Did you find it on Bank of Canada website, or how did you find that?
Yeah, man. Just Milan, just search overnight lending rate and bank of and bond yields. And
Yeah,
you should be able to
there's a lot of websites where you could find different charts.
yeah, or you can just
Okay.
follow along on the screen.
Yeah.
So Carmelo, let's move.
So again, and the other thing that's important with Canada and what's been happening is unemployment, right? The Bank of Canada has a hard time forecasting what's going to happen because if these tariffs are short-lived or long-term, they came up with these two scenarios because they don't know what's going to happen. So they pause today because they don't know. And when I look at the unemployment in Canada over the last 3 years, right, we could see 2022, 2023 was extremely low, but then it rised, and now we're at unemployment. Let's just call it 6.6 plus or minus. Like these are a lot higher numbers than what we had 2 years ago. And if the Bank of Canada, they pause today because they don't know what's going to happen to the economy. They don't know what these tariffs are going to do, whether they're going to be short-lived, long-lived. And if my concern is if unemployment keeps on rising, inflation is not an issue because if nobody's got money, nobody's got jobs to work, those people don't really care the price of goods. They need to work to pay their bills, keep the house lights on, take their kids to school and put food on the table. So unemployment is a measure that they look at, but this is not their mandate. Their mandate, the Bank of Canada's mandate, is inflation. They do their best, and they realize with these tariffs, the Bank of Canada's job is not to. They can't support the economy if we're in a long tariff war. We need our we're going to have an election in 2 weeks. The federal government to take a big role when it comes to these tariffs and these trade wars.
I think it's one of the most important elections that we've had in our lifetime, or that we will have. And Canadians do carry a lot of consumer debt. So if people don't have jobs to pay their bills, like it's going to put us in a very tough situation.
So I look at this a lot because unemployment is something. If people aren't working, people cannot borrow money. People cannot buy real estate or sell real estate. And employment's a big thing. And we've already seen a few factories shut down in southwestern Ontario. I'm sure there's a lot more across Canada that I'd never even heard of, and businesses being impacted. Yeah. But this is what I personally pay attention to this because, again, it's important that our economy, the strength of our economy, is based on the number of people that are working. And if people are not working, we're just not going to have a strong economy. Yeah. So kind of like what to expect moving forward. Really? Who knows? Like, look at Trump just comes up with these trade wars and these trade numbers, and it's like the Bank of Canada. Nobody has a clue. I don't know if Trump knows what he's doing. Like, nobody's got a clue what's going to happen.
I like that it says there that this includes currency manipulation and trade barrier. These tariffs charged to the U.S. Like, what does that even mean?
I don't know. Anybody here know? Anybody familiar with what they're doing down there?
Yeah.
This is a good time for us to kind of there's not much more to share when it comes to pictures, right, or a deck, but we don't know what's going to happen. Like right now, uncertainty is at an all-time high, right? So for the Bank of Canada having two different scenarios and saying at the very end, there's multiple scenarios. It's true. Nobody knows. And how could they talk to the country governing our finances and give a forecast without knowing what's going to happen when things literally happen based on a tweet?
Yeah. Or how can businesses make decisions with all this uncertainty?
Yeah.
How can they decide to build a new manufacturing plant? How can they decide to bring something to Canada? It's very challenging. And I think that's the biggest impact from all of this. Is just psychological.
Absolutely. Now I kept this chart. This is an old. And I'll try to describe this graph. Like the blue line is what happened to inflation from 1966 to 1982. So I was born in 77, so all this doesn't really mean it's all history. It's water under the bridge. But the blue line in the 70s, there was a massive inflation. Then it came back down, and then there was another massive inflation. And I was just a child at the time, so I really didn't. I can't explain what happened, when, why. But the one thing I can talk about is I'll call it that's the golden line, Alex. From 2023, from 2013 till 2023. I couldn't get anything that's a little bit more up to date with 24, but we saw in the golden line, we saw inflation spike up around the same. The rate, the length of time is the same, and then we saw inflation come back down. Well, with these tariffs, my question is, are we going to go through another spike in inflation? Because this is one thing I know the Bank of Canada does not want to happen.
That
Like,
chart
here's-
kind of looks nice. I'm wondering how this compares to the inflation we're at like right now. If there could be a chart to go up until 2025 to see how we're doing compared to the past with inflation.
The best I could, I would have guessed the golden line would probably be within this, near the bottom band, right? It's come down. We're near the bottom of the first triangle. I'm more interested in the next 7 years. What's it going to look like? Is it going to be a repeat, or is it going to be just maybe like this is the unknown. Part of the purpose of the chart is also what's going to happen next. We don't know. I'm optimistic that the people in charge are not going to let inflation run up again. But the truth is, we live in a global environment, and what happens in other places in the world does impact us, especially the United States.
It's the biggest trading partner, and it's also the biggest economy. So, yeah, is that the last slide, Carmelo?
Yeah, that's about it. Now it's like let's have a good conversation, all of us. Open the floor with regards to let's all discuss together, right?
What's going on? So, yeah, I'm going to stop